There is a city where the desert was not gradually settled, but violently conquered. Where glass towers rose faster than most countries build roads. Where a shopping mall became so large it contains an aquarium with 33,000 aquatic animals, an indoor ice rink, and 1,200 stores spread across more than 1 million square meters of retail space. A city that did not grow into a luxury capital, it declared itself one, and the world's most powerful brands agreed. The StoxX Europe Luxury 10 Index fell approximately 9% across 2 trading sessions. Shares of LVMH, Kering, and Burberry each approached 10% losses within days. Richemont fell 5.7% in a single session. Roughly $100 billion in global luxury market value was erased. Foot traffic at Dubai Mall dropped approximately 50% in March 2026. Mall of the Emirates saw footfall fall by 15%. Hotels projected occupancy collapsing from 80% to as low as 10% by the end of the second quarter of 2026. 8 luxury retail operations shuttered. And together, their stories form a picture not just of a city under pressure, but of an entire commercial model being tested to its absolute limits. The foundation that made this possible. Before the collapse can be understood, the scale of what existed needs to be stated plainly. Dubai Mall attracted close to 100 million visitors annually in its peak years, a figure that exceeds the entire population of Germany walking through one building every 12 months. Fashion Avenue, the mall's luxury corridor, housed the flagship presence of virtually every major house in global luxury. Chanel, Louis Vuitton, Hermès, Cartier, Van Cleef & Arpels, Gucci, Dior, Balenciaga, Saint Laurent. Names whose combined brand value runs into hundreds of billions of dollars, all concentrated in a single retail district inside a single building in a city that did not exist as a modern metropolis 50 years ago. For mega brands like Louis Vuitton, Hermès, and Chanel, annual sales per square meter in Dubai can surpass several €100,000, multiple times the global average. The reasons are structural. Tax-free pricing. A permanently resident, ultra-wealthy population. A golden visa program that had been attracting millionaires from across the globe at an extraordinary rate. 9,800 millionaires moved to Dubai in 2025 alone, bringing an estimated $63 billion in wealth, more than any other city on Earth that year, according to Henley & Partners. Dubai's millionaire population had doubled since 2014 to more than 81,000 individuals. According to Visa's Global Economic Insight data, nearly 1 in every 9 Dubai residents made a luxury purchase every quarter in 2025, a frequency that far outpaced comparable figures in London, Paris, or New York. Richemont, the Swiss conglomerate that owns Cartier, Van Cleef & Arpels, IWC, Jaeger-LeCoultre, and Vacheron Constantin, reported 20% sales growth in its Middle East and Africa region in the quarter ending December 2025. Its 9-month sales to December 2025 increased by 10% at constant exchange rates. Swiss watch exports to the UAE reached 1.316 billion Swiss francs in 2025, up 3.5% year-on-year. LVMH's own chief financial officer, Cecile Cabanes, described Dubai as recently as January 20th, 2026, as a market displaying significant growth. Days before the conflict erupted, Louis Vuitton had staged a major brand exhibition at the Jumeirah Madinat Al Arab Hotel. Cartier had just unveiled its Onalibra high jewelry exhibition at Dubai's Couture Park, a lavish event prepared for months, representing the brand's deepest commitment to the Gulf as a destination for its most exclusive offerings. Sephora had announced the launch of its first Saudi beauty brand. The confidence was not irrational. It was built on real numbers, real infrastructure, and real consumer behavior. And then, in a single weekend, the conditions that produced all of it ceased to exist. What happened in 72 hours? On February 28, 2026, the U.S.-Israeli air campaign against Iran expanded with no immediate end in sight. Tehran fired missiles and drones at Gulf states in retaliation. The UAE was struck by multiple missile and drone attacks. Dubai's major airport hub was targeted multiple times by Iranian drone attacks, along with other critical infrastructure. The landmark Burj Al Arab Hotel suffered damage when debris from an aerial interception struck its facade. European airlines immediately suspended flights into the region. Dubai International Airport, which serves as the world's busiest international aviation hub, began operating with severely reduced capacity. The tourists, Russian high spenders, Chinese luxury consumers, Indian fashion buyers, European visitors, who formed the backbone of tourist-driven luxury spending in the UAE, simply stopped coming. Dubai airports reported that first quarter 2026 passenger traffic was down by at least 2.5 million compared to the same period in 2025, with March alone seeing a 66% drop in passenger numbers. According to Morgan Stanley, around 60% of luxury spending in the UAE comes from tourists, of which 60% are Russian, Saudi, Chinese, and Indian visitors. Moody's Analytics projected that Dubai's hotel occupancy, which had stood at approximately 80% in February 2026, could fall to as low as 10% by the end of the second quarter. In its own language, Moody's described the situation as an effective shutdown of large parts of the hospitality sector. Dubai authorities introduced temporary relief measures allowing hotels to defer taxes on rooms and food and beverage for a 3-month period starting April 1st, an extraordinary acknowledgement of the depth of the crisis. According to sources with direct knowledge of mall performance figures, luxury brands in March 2026 reported sales drops of 30 to 50% at Mall of the Emirates compared to the same month the previous year. Traffic at the larger Dubai Mall, more dependent on international tourists, was down approximately 50%, indicating a potentially even larger sales decline. In Abu Dhabi, a smaller shopping hub less reliant on tourist spending, March sales at the Galleria Mall were more resilient, but still down around 10% across the board. The entire commercial ecosystem of the most ambitious retail city ever built had gone from peak performance to crisis in less than 72 hours. Number 8. H&M and Primark, the collapse nobody predicted. The instinct, when luxury retail fails, is to look at the Grand Maisons, the Chanels, the Cartiers, the houses whose handbags cost more than most people's monthly salaries. But the story of Dubai's retail crisis in 2026 begins somewhere more unexpected, with H&M and Primark. Their inclusion in this collapse is not incidental. It is diagnostic. H&M, the Swedish fast fashion giant with over 5,500 stores across 77 markets globally, had built a meaningful, profitable presence across the Gulf. Its stores in Dubai did not serve the ultra-high net worth clientele filling the Gucci boutiques. They served the vast expatriate middle class, the Filipino nurses, the Indian engineers, the British marketing professionals who make up the overwhelming majority of Dubai's actual population. In early March 2026, H&M confirmed that its stores in Bahrain had closed, while across the broader UAE, operations were disrupted as the security environment made normal retail commerce functionally impossible. Primark's story is even more instructive about the timing and scale of what was lost. The Irish fast fashion retailer, owned by Associated British Foods, had made one of the most significant strategic announcements in its recent history just months earlier. It would open 3 stores in Dubai across March, April, and May of 2026, followed by locations in Bahrain and Qatar by the end of the year. This was Primark's formal entry into the Gulf, years in the planning, representing genuine confidence in Dubai as a mass-market retail destination at the precise moment everything collapsed. A spokesperson confirmed that Primark was monitoring the situation closely, the corporate language for a timeline that had become deeply uncertain. When the disruption is severe enough to take down not only the most exclusive boutiques in the world, but also the mass-market retailers serving the millions of workers who form the economic base of any functioning city, this is no longer a luxury crisis. It is a systemic one. The retail pyramid collapsed simultaneously from its peak and its foundation. Number 7. Apple. When the most powerful brand on earth goes dark. There are stores in Dubai Mall that function less as retail spaces and more as landmarks. The Apple Store, with its signature minimalist architecture, long white tables, carefully calibrated lighting, and glass walls opening onto the mall's interior, was one of them. Apple is, by any reasonable definition, a luxury retailer. Its products occupy the highest price tier in every category they compete in. Its retail experience is deliberately curated. Its global store count is deliberately limited. And in Dubai, where the convergence of tech culture and aspirational lifestyle is particularly intense among the city's young, affluent, internationally mobile resident base, The Apple Store occupied a position in the retail hierarchy that no competitor could replicate. Apple confirmed that all of its stores in the UAE would remain closed following the initial outbreak of the conflict. The closure was a safety decision made rapidly in response to a genuinely dangerous environment. But its symbolic impact was disproportionate to its operational significance. For the thousands of Apple-certified technicians, retail specialists, and support staff employed across the UAE's Apple ecosystem, both directly and through third-party authorized service providers, the closures created immediate financial uncertainty. The image of Apple's glass-walled stores going dark in one of the world's most prosperous commercial cities communicated one thing with absolute clarity: no brand, regardless of its financial power, cultural dominance, or brand equity, is immune to a geopolitical shock severe enough to make an entire city functionally unsafe for retail commerce. Number 6. Sephora. The lipstick effect has a limit. The global beauty industry has a well-documented resilience mechanism economists call the lipstick effect. During downturns and periods of consumer anxiety, sales of prestige beauty products, lipsticks, fragrances, skincare serums, tend to hold steady or even rise, because they represent an accessible form of luxury that consumers reach for when larger indulgences are unavailable. Sephora, the world's leading prestige beauty retailer with over 3,000 stores in 35 countries, had built one of its most commercially productive regional operations in the UAE. Operated across the Gulf through the Chalhoub Group, the Dubai-based retail giant managing 900 stores across the region, Sephora's Gulf locations served a consumer base with an extraordinarily high appetite for prestige beauty. The UAE is one of the world's largest per capita markets for fragrance and skincare, driven by high disposable incomes, a strong cultural emphasis on personal presentation, and a tax-free retail environment. In the days just before the conflict erupted in late February 2026, Sephora had announced the launch of its first Saudi beauty brand, a signal of its deepening commitment to local market development across the Gulf. The timing could not have been more catastrophically unfortunate. Within days, the crisis had shut Sephora's Bahrain locations entirely and reduced its UAE operations to skeleton crews of voluntary staff. The lipstick effect has a limit. It operates when the mall itself can safely open its doors. When that condition fails, no amount of consumer psychology protects the category. The Gulf's prestige beauty market supports an enormous ecosystem: local distributors, beauty influencers, salon professionals, and freelance makeup artists whose livelihoods depend directly on the health of retail beauty spending. All of it paused in a single weekend. Number 5. Versace and Jimmy Choo. Status luxury without an audience. Few brands carry the iconography of aspirational luxury more completely than Versace and Jimmy Choo. One is Italian maximalism made wearable: the bold prints, the gold hardware, the unapologetically excess-forward aesthetic that has defined a vision of glamour for over 4 decades. The other is a British institution whose name is synonymous with footwear that appears in the purchase aspirations of fashion consumers on every continent. In Dubai, both had been essential fixtures of the Gulf's luxury retail landscape for years, operated through the Chalhoub Group's vast regional network. The commercial logic of their Gulf presence was backed by hard data. Visa's Global Economic Insight data showed that nearly 1 in every 9 Dubai residents made a luxury purchase every quarter in 2025, a frequency that far outpaces comparable figures in London, Paris, or New York. When the crisis struck in early March 2026, both brands felt the immediate impact. Their UAE stores moved to voluntary staffing. The tourist traffic that drives a significant portion of Gulf luxury fashion sales evaporated almost instantly. Dubai International Airport was operating with severely reduced capacity. Russian tourists, Chinese high spenders, Indian fashion consumers, and European visitors, who collectively represent the backbone of tourist-driven luxury fashion revenues in the UAE, stopped coming. According to Dubai Airports, first quarter 2026 passenger traffic was down by at least 2.5 million compared to the same period in 2025, with March alone recording a 66% drop. For the workers who staff these boutiques, many of them young professionals from South and Southeast Asia building careers in Dubai's retail sector, the crisis created immediate income uncertainty. A status luxury brand without an audience is, commercially, just an empty room with expensive furniture. Number 4. Gucci. Internal crisis meets external catastrophe. There is perhaps no single brand whose story in 2026 more completely captures the convergence of internal decline and external catastrophe than Gucci. The Florentine house arrived in 2026 already severely damaged. Its parent company, Kering, had watched Gucci's revenues collapse by 22% in 2025 alone, falling from over 7.65 billion euros to approximately 5.99 billion euros in a single year. A new creative director, Sabato de Sarno's successor, had taken over in July 2025. A new CEO, Francesca Bellatini, had arrived in September 2025. The house was, in every meaningful sense, mid-reinvention. Against that backdrop, the gulf had represented something precise and rare for Gucci. A market that was still growing, still aspirational, still willing to spend on the kind of bold, logo-forward luxury the brand has always embodied. Dubai in particular had been one of the markets where Gucci's retail performance remained relatively resilient even as global figures deteriorated. Its flagship presence in Dubai Mall's Fashion Avenue represented not just revenue. It represented proof that the brand's reinvention still had a commercially engaged audience. Then on March 2, 2026, Kering made the most definitive shutdown decision of any major luxury conglomerate in the region. All Gucci stores across the UAE, Kuwait, Bahrain, and Qatar were closed. All business travel to the Middle East was suspended. Kering's finance chief Armel Palou confirmed that the conflict shaved 3% off overall Kering sales in March and 1% on the quarter as a whole, with a similar effect at Gucci specifically. Retail revenues in the Middle East declined by 11% in the first quarter, despite growth in the first 2 months of the year before the war started. Gucci's first quarter 2026 sales came in at 1.35 billion euros, the 11th consecutive quarterly decline for the brand. Kering had already announced 100 additional store closures globally for 2026, with Gucci expected to absorb the largest share. The intersection of two entirely different categories of failure, one manufactured in a boardroom in Paris, one triggered by a military strike thousands of kilometers away, produced an outcome more damaging than either would have created independently. Number 3. Balenciaga and Saint Laurent. Culture cannot substitute for stability. If Gucci represents the most commercially significant case within the Kering portfolio, then Balenciaga and Saint Laurent represent its most culturally resonant ones. Balenciaga, under successive creative leadership, had become arguably the most culturally influential luxury brand operating anywhere in the world. The house that fundamentally redefined what a luxury sneaker could cost and what the relationship between high fashion and internet culture might become. Saint Laurent had spent years building one of the most consistently aspirational identities in French luxury: sleek, Parisian, effortlessly expensive. Both brands had invested meaningfully in the Gulf. Saint Laurent's boutiques in Dubai attracted the most sophisticated luxury consumers in the region, those who prefer coherent understatement to conspicuous excess and who are loyal to brands with a durable, legible aesthetic built over decades. Balenciaga's presence had tapped into a younger, more digitally native segment of the Gulf's luxury consumer base, the generation for whom a triple S sneaker represents a different vocabulary of luxury, signaling than their parents' Cartier watches. The closure of both brands' Gulf operations in early March 2026 sent a message that transcended their individual commercial impact. These were brands that had been aggressively expanding in the region, investing in experiential retail formats and local market partnerships. Their sudden absence from Dubai's retail landscape was the equivalent of pulling two of the most prominent exhibits from a museum mid-exhibition. The galleries did not simply become empty. They became visible, physical evidence of a disruption so severe that even the most culturally ambitious brands in global luxury could not sustain their presence. Cultural momentum, however powerful, cannot substitute for the basic precondition of geopolitical stability. Number 2. Richemont, Cartier, and Van Cleef & Arpels. Permanent luxury goes dark. Of all the luxury conglomerates with exposure to the Gulf retail market in early 2026, none faced a more structurally concentrated risk than Richemont. The Swiss group, which owns Cartier, Van Cleef & Arpels, IWC, Jaeger-LeCoultre, Vacheron Constantin, Piaget, and Chloé, among others, derives approximately 10% of its total global revenues from the Middle East and Africa region. Among the major luxury conglomerates, that figure represents the highest single-region concentration in the entire sector. The UAE alone accounts for approximately half of all Middle East luxury revenues, meaning Richemont's effective Dubai exposure was far more concentrated than any regional aggregate could suggest. Richemont's flagship brands belong to the hard luxury category, fine jewelry, and prestige watches. This is the segment most resistant to fashion cycles and most consistently associated with multi-generational wealth preservation. Swiss watch exports to the UAE reached 1.316 billion Swiss francs in 2025, up 3.5% year-on-year. Richemont had reported 20% sales growth in the Middle East and Africa region in the quarter ending December 2025, the highest regional growth figure of any business area in its entire portfolio. The timing of what followed was devastating in its precision. Cartier had unveiled its Onalibra high jewelry exhibition at Dubai's Couture Park, a major event representing the brand's deepest public commitment to the Gulf as a destination for its most exclusive offerings. Days before the conflict erupted, the exhibition had been prepared for months. Before the last champagne glass was cleared, the region became an active conflict zone. Richemont shares fell 5.7% in a single session on March 2, 2026, the steepest single-day decline of any major luxury conglomerate that day. Cartier and Van Cleef & Arpels do not simply sell products. They sell permanence, the idea that beauty and value endure across generations. The irony of their sudden, forced absence from the very market that had most enthusiastically embraced that message is one of the defining contradictions of Dubai's 2026 retail crisis. Number 1. LVMH, Louis Vuitton, and Dior, the world's largest luxury group in full retreat. To understand the weight of LVMH's retreat from Dubai, it is necessary to first understand what LVMH actually is. With a portfolio of over 75 brands spanning fashion, leather goods, perfumes, cosmetics, watches, jewelry, wines, spirits, and selective retailing, LVMH is the largest luxury conglomerate on earth, the single most influential force in determining where global luxury retail moves next. Its flagship brand, Louis Vuitton, is the most valuable luxury brand in the world by essentially any measure. In Dubai, LVMH had built what its own CFO described as recently as January 20th, 2026, as a market displaying significant growth. Louis Vuitton had staged a major brand exhibition at the Jumeirah Madinat Al Arab Hotel in February 2026, just weeks before the conflict erupted, signaling the kind of high investment commitment that brands make only to markets they consider strategically essential. Dior's flagship presence in Dubai Mall's Fashion Avenue ranked among the most architecturally significant luxury retail spaces in the entire city. Sephora had just launched its first Saudi beauty brand. Rimmel, Tumi, and Kenzo, all LVMH properties, had been expanding rather than contracting in the months immediately before the crisis. Then in the first days of March 2026, LVMH brands shut across the UAE for a minimum of 2 days, explicitly prioritizing employee safety above compliance with retail lease obligations. LVMH's other market segment, which includes the Middle East, accounted for 14% of its total revenue in 2025. The company's Q1 2026 organic sales growth came in at just 1%. The Middle East conflict accounted for a 1% negative impact on organic growth, effectively cutting quarterly growth in half. Over the 2 months following the initial conflict escalation, LVMH shares fell by more than 10%, erasing billions of euros in market capitalization. Bernard Arnault, speaking at LVMH's annual general meeting in Paris, did not minimize the situation. "The world is now in a pretty serious crisis in the Middle East," he told shareholders. "Either it'll be a world catastrophe with very serious and very negative economic impact, in which case, who can say how 2026 will unfold, or it will be resolved more rapidly in some shape or form that we all hope for, even if it doesn't seem to be easy, in which case, business will recover and resume their normal course." Kering's Middle East retail revenues declined 11% in Q1 2026. Hermès, which has historically demonstrated greater resilience due to its ultra-wealthy clientele, still significantly missed its first quarter sales mark. stating that wholesale activity was significantly affected by lower sales to concession stores, particularly in the Middle East and in airports. McKinsey senior partner Jim Adoria, speaking to CNBC, described what brands were reporting on the ground. What I am hearing from our clients is that there is a double whammy of consumer sentiment declining, traffic declining, and spend declining. The sight of Louis Vuitton and Dior going dark in the world's most visited retail destination was more than a business disruption. It was a definitive statement about the limits of commercial ambition in a world where geopolitical reality can override any retail strategy, any marketing investment, and any growth projection ever made. The countercase, Dubai is not finished. Against the full weight of what the closures reveal, certain structural facts about Dubai do not disappear. Emaar Properties announced a 1.5 billion dirham expansion of Dubai Mall, adding 240 new premium stores. Majid Al Futtaim committed $1.36 billion to upgrade Mall of the Emirates, introducing 100 new stores. Hermes reported 14.9% growth in its Middle East-heavy region in 2025. 9,800 millionaires moved to Dubai in 2025, bringing $63 billion in wealth, more than any other city on Earth. The Golden Visa program continues to function. Tax-free pricing, world-class infrastructure, and a permanently resident ultra-wealthy population remain intact. Bernstein luxury analyst Luca Salca offered a measured assessment. Most of the companies we've been talking to are not really pointing to a disastrous decline in the Middle East. At the end of the day, if this was contained to the month of March, this would largely be a non-event. Arnault himself told shareholders he expects a return to growth in the second half of 2026 if a resolution to the conflict is reached. A ceasefire is currently in place. Dubai authorities announced, in early May 2026, that all air travel restrictions had been lifted. The structural case for the city, wealthy permanent residents, tax-free pricing, formidable infrastructure, the most aggressive millionaire attraction program of any city on Earth, has not been destroyed. It has been stress-tested. What 8 closures actually tell us? Carol Maggio, head of luxury research at Barclays, summarized the industry's relationship with the Gulf bluntly. It was definitely a strategic region. Everything was okay. That past tense carries the entire weight of what 2026 has revealed. The global luxury industry's geography of optimism had become dangerously narrow. For years, as China softened, as American aspirational consumers retreated, as European tourism shifted, the industry leaned on a single region, the Gulf, and Dubai above all, to carry the weight of its growth narrative. The Middle East was delivering 4 to 6% growth in 2025, while global luxury sales had flatlined at 358 billion euros. That concentration of dependence turned out to be a structural vulnerability. When the Gulf faltered, the entire global luxury narrative faltered with it. $100 billion in market value erased, 9% of the StockX Europe Luxury 10 Index in 2 trading sessions, the most powerful retail brands on Earth unable to open their doors. Physical retail, despite years of digital transformation investment, remains acutely exposed to forces that no lease agreement, no brand identity, and no omnichannel strategy can neutralize. No digital transformation eliminates the fundamental dependency on a physical retail environment that requires, at its most basic level, that people feel safe walking through a door. And Dubai itself contains a contradiction that its promotional apparatus has long preferred not to state plainly. It is a city of approximately 9 million people, of whom fewer than 12% are citizens. Its economy is built on the continued willingness of the world's most mobile wealth to remain in place. Its retail empire depends on airports remaining open, on tourists continuing to fly, and on the geopolitical order of a historically volatile region remaining stable enough for a consumer to walk into a boutique and consider a purchase. Christopher Rosbach, portfolio manager at J. Stern & Co. in London, framed the industry's position clearly. If it now turns out that whatever luxury recovery we were hoping for in 2026 is not going to happen, and it's going to be postponed at best into the second half or into next year, I don't think anybody can be surprised by it. Luxury is not simply the product. It is the atmosphere that surrounds the product. It is the confidence of the consumer. It is the certainty that tomorrow will be, at minimum, as stable as today. When that confidence evaporates, the product sitting behind the glass case becomes commercially irrelevant. The shuttered boutiques of Dubai in 2026 are not evidence that consumers stopped wanting beautiful things. They are evidence that wanting is not sufficient. The conditions for desire must also be maintained. Dubai will rebuild. The investment is too deep, the infrastructure too formidable, the resident wealth too real for the city to cease functioning as a luxury destination. The new malls will open. The brands will return. The tourists, eventually, will come back. But the version of Dubai that emerges from 2026 will carry something the previous version did not: an honest public record of its own contingency. And the global luxury industry, which bet heavily on a single brilliant market to carry the weight of an entire sector's recovery, will have to find an answer to the question that 2026 has made impossible to ignore. When the next geography of hope reveals itself, and the brands move in, and the flagships open, and the investment announcements multiply, who will have the structural analysis ready to ask, plainly and without sentiment, how exposed are we, and to what?